Today's the 25th of February 2020. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500, which had a fairly strong move downwards yesterday. I'm going to be discussing whether the stock markets around the world are turning bearish. Before we take a look at the markets, please make sure that you have read and understood these disclaimers. So let's take a look at the chart of the S&P 500. This is the analysis that we have been tracking in these market updates. And of course, we had a 40-week cycle trough at the beginning of October last year, an 80-day cycle trough at the beginning of December. And in my previous market update, I discussed the fact that I believe the 20-week cycle trough had formed on the 31st of January. Now, we received several emails yesterday because of the strong move downwards, asking whether that strong move downwards affected the position of the 20-week cycle trough. Well, it might do, and we're going to be taking a look at that in a moment. First of all, if you haven't watched previous market updates in this series, then I would encourage you to do so, because a Hurst cycles analysis is a bit like a story that evolves over time, and it's quite important to understand the background to that story. I'm going to be skipping some of the details in the interest of keeping this video as short as possible. So, in my opinion, the 20-week cycle trough did in fact form on the 31st of January, and yesterday's strong move down doesn't change that. But we can take a look at an analysis that presents the possibility that a 20-week cycle trough still lies ahead of us, and we can discuss the reasons why I think it is not quite as good an analysis. So let me turn off that FLD just for the moment. So here is an analysis that shows that the 20-week cycle trough still lies ahead of us. There is the nest of lows for the 20-week cycle trough. So this is really the analysis that we were tracking until a couple of weeks ago, when the 20-week cycle trough appeared to occur on the 31st of January. This was the alternate. That the 20-week cycle trough still hadn't occurred. And it's very important to keep an eye on different analyses, in my opinion. So this is an analysis that I've also been watching. And when price came down yesterday, of course, it looked as if though finally price was coming down into the 20-week cycle trough. But now, why do I think this is a less likely analysis? Well, as I've mentioned in several previous market updates, when a market is bullish, and this market has been bullish, let's be honest about it, up until yesterday, the market has really been very bullish. It's been moving pretty much consistently upwards. One down day doesn't make a bear market, of course, but it is important to bear in mind that, as I mentioned in previous market updates, this market does need to turn down in order to reach an important trough towards the middle of the year. So we have been on the lookout for signs of bearishness. Nevertheless, the point is that this market has been bullish. And as mentioned in previous market updates, when a market is bullish, we expect troughs to occur early. It is something that Hurst called time translation. In a bullish market, troughs occur early. In a bearish market, peaks occur early and troughs occur late. So let's have a look at these bar counts. Since the 40-week cycle trough in October of last year, there have been 145 days that have elapsed. Now, the average length of a 20-week cycle is 136 days, and so therefore, if the 20-week cycle still lies ahead of us, or if it occurs today, then it would be 9 days late. Now, that's not impossible, of course. That's a very small variation, so it is absolutely possible. However, bearing in mind that this has been a bullish market, we would have expected the trough to occur early rather than late. The same thing applies for the 80-day cycle, which has been running for 84 days since the trough at the beginning of December. And the average length of an 80-day cycle is 68 days. So that cycle is now 16 days late. At least the trough is 16 days late. Again, we would have expected it to occur early rather than late because of the bullishness of the market. And the 40-day cycle has currently been running for 48 days, and the average length of a 40-day cycle is 36 days. If that confuses you, please make sure that you download the free 10 core concepts of Hurst cycles document, which I will provide a link to beneath this video, which explains some of these basic concepts. So that 40-day cycle would be 12 days late. And given the recent bullishness of this market, we wouldn't expect it to be so late. So those are some reasons why I think that the 20-week cycle trough did in fact occur on the 31st of January. Now, there is another reason, which has to do with the way in which price has interacted with the FLD. So let's zoom in here and take a look at this 20-day FLD, which you will know is a very useful FLD in my opinion, because we track the interactions between price and the FLD. So following the 80-day cycle trough that occurred at the beginning of December, we had our A category interaction. The B and C were pretty much hidden because of the extreme bullishness of the market at that time, but they were as price came down to the 20-day cycle trough in the middle of December. The 40-day cycle trough experiences the D and E category interactions either side of the 40-day cycle trough, which occurred, in my opinion, on the 8th of January of this year. The next interaction should therefore have been the F category interaction. And as discussed in previous market updates, price then pulls back towards the 20-day FLD in a G category interaction. The market revealed a little bit of bearishness. It was almost the first sort of bearish crack that appeared in this market when the market failed to reach that FLD. It was a very subtle sign, didn't have a lot of meaning at the time, but I did point it out. A very subtle sign that some bearishness was perhaps about to enter into the market. The H category interaction took place over pretty much one day as price dropped down into this trough. Now, that is a pretty good and clear and clean sequence, but that would then indicate that the 20-week cycle trough formed at that point. What then is this interaction? Well, some people might say this is actually the G category interaction and this is the H category interaction. Well, strictly speaking, yes, that could be true. However, what's very important to consider is the characteristics of these interactions. So each interaction has its own unique sort of way of behaving, the way that price behaves around the FLD. And a G category interaction is very rarely, in my experience, a matter of price crossing up above the FLD, fulfilling its target and exceeding it, and then dropping back down below the FLD. So this whole sequence of FLD interactions, while very useful for planning the kind of trades that you're going to make, it's also very useful, in my opinion, for distinguishing between two different analyses. So that interaction doesn't really make a lot of sense according to the fact that we're still expecting the 20-week cycle trough to occur. Let's switch back to the other analysis where we can see the 20-week cycle trough there marked in the analysis, and we'll display the 20-day FLD and discuss that sequence again. So here we have the A category interaction. Here are the B and C category interactions. They were hidden, as I mentioned. Here is the D category interaction as price came down to the 40-day cycle trough. And here is the E category interaction as price crossed back up above the FLD following the 40-day cycle trough. Here then is the F category interaction. There is the G, as mentioned in the previous market update, and the H category interaction. This interaction is then an A category interaction following the formation of the 20-week cycle trough. The B and C category interactions, in my opinion, again, formed early in this market. You could argue that they happened here or that they happened here. So we had a very subtle B and C. Now remember, the B category interaction, price is expected to find support at the level of the FLD. So the fact that it came down very close to that FLD at that point is fairly good for a B and C category interaction. That makes this here a D category interaction, and I posted a video to the Hurst Cycles community on Saturday morning discussing the fact that I thought that was a D category interaction. I still think it's a D category interaction, and I think the price is now coming down into the 40-day cycle trough. So if this is the case, surely that's a strong move down into the 40-day cycle trough. Yes, it is. And that's really what I've been saying recently, that we need to be on the lookout for the fact that this market is going to turn bearish. And markets turn bearish in this manner. They cross down below the FLD in a D category interaction, and they drop further than expected on their way down to forming the 40-day cycle trough. So if this market has turned bearish, and there is definitely a bearish turn there, if this particular analysis is correct, then of course we have so far we have a fairly balanced 40-day cycle instead of a strongly bullish 40-day cycle. Now, for the first 40-day cycle following a 20-week cycle trough, you would expect it to be very bullish. The fact that it's not indicates that the market is turning bearish. So let's just zoom out and consider what we are expecting to happen next. So here we go. I've zoomed out and I've added this orange line, which is called a composite model line, which takes the information from the cycle analysis, recomposes it, the cycle wavelengths and amplitudes, and demonstrates in the past what would have happened if only the cycles shown in the analysis at the foot of the chart had been influencing price movement. You can see that the general structure of this composite model line is actually fairly close to what has been happening in the markets. And so what is the composite model line saying at the moment? Well, as you can see, it is indicating that it expected price to come up to one higher peak, but generally price is in the process of forming a peak in the market, and then price is expected to move down into this 18-month cycle trough, which, as I've mentioned before, is expected in about the middle of this year. So this is the analysis that includes the 20-week cycle trough on the 31st of January. And that composite model line matches quite closely what has been happening both in the past, but it also gives us a projection for what is expected to happen looking forward, assuming that this analysis is correct. What about the fact that the market has formed a peak here instead of over here? Well, the composite model line is using the cycle information as they have been playing out, and using the past information of the way in which the cycles have been performing, we would have expected the peak of the current 80-day cycle to have been the higher peak. However, the fact that it looks as if though this first peak is going to prove to be the peak of the current 80-day cycle, and we don't know that yet. The market might still jump up and form a higher peak, but the fact that that looks fairly clearly as if though the peak of the current 80-day cycle has formed indicates that the peak is occurring earlier than expected. Now again, we apply the principle of time translation. An earlier peak indicates that potentially the market is turning bearish. So therefore we are beginning to see some bearishness, not simply because of a strong move down yesterday, but because of the fact that we at the moment have an earlier peak. If price comes up and forms the later peak, then of course that argument will be annulled. Nevertheless, the expectation is clear. The market is in the process of forming a peak, and we're expecting a move down into the middle of the year for that 18-month cycle trough. Now, as a matter of interest, people often take a look at the composite model line, both on my videos and on their own versions of Sentient Trader, and they read off the levels. That is a mistake. If you have a look at the difference in levels between price and the composite model line, it's always a mistake to actually read the levels off the composite model line. The composite model line reveals the cycle structure, and one of the most variable aspects of cycles in the way that they influence financial markets is their amplitude. And so the amplitude is expected to vary quite a lot. And so what's more important is that we're expecting a move down rather than the actual level at which that move down is expected to end. It's a very important point to bear in mind. Let's take a look at the other analysis. And here I have done the same thing. I've applied the composite model line, and you'll notice that this analysis, which of course doesn't differ in the past apart from the position of the 20-week cycle trough, that's really the only difference in this analysis. There is also a difference in terms of the much longer term cycles, which in the other analysis were positioned prior to current market conditions, but we're not going to have time to discuss that at the moment. The important thing is that we have a nest of lows of important cycles of at least 18-month magnitude, perhaps longer. In my opinion, it's only going to be an 18-month cycle trough that's going to form in the middle of the year. And this composite model line is also indicating that it is expecting price to move downwards. However, interestingly, it's not expecting price to move downwards nearly as much. You can see that the degree of downward movement is very much muted. Why is that? Well, it's because of the cycle information that it is reading from the analysis, and the specific details are a little complex to go into here, but it's measuring the amplitude and the wavelengths of all of these cycles. And in this particular instance, it's making the assumption that the 20-week cycle trough has not yet formed, and therefore this recent action just over the past month or so is influencing the information about the current cycles that have been playing out over the past month, and it's affecting the formation of the composite model line. Nevertheless, both analyses are indicating that the market is expected to come down into the middle of the year. And so the really big message for this video is that that is what we're expecting. We're expecting the market to drop into the middle of the year. This analysis, of course, because the 20-week cycle trough is still lying ahead of us, is showing in the composite model line that it's expecting a bounce out of that 20-week cycle trough, and then the market's going to come down. So we're going to be watching carefully as the market comes down and forms either a 40-day cycle trough, followed by probably not a very strong move up, or to see whether it does form the 20-week cycle trough. In my opinion, as I've mentioned several times, I think the 20-week cycle is behind us, but we will be watching the market very carefully to see which scenario plays out. I do hope that you found this video interesting and useful. If you have any questions, please put them in the comments below the video, and I look forward to seeing you next time.